Imagine trying to send money across borders, perhaps to a loved one, or to pay a supplier. The process often feels like navigating a labyrinth. Banks impose hefty fees, transactions can take days, and sometimes, a wire transfer simply gets stuck, leaving both sender and receiver in limbo. You might pay 5%, 10%, or even more, just to move your own money. For billions around the world, these are not abstract problems, but daily frustrations that chip away at their financial well-being and trust in the system. What if there was another way, a more direct, transparent, and less costly path for your money? For centuries, the foundation of our financial system has been trust. We trust banks to hold our money safely, to process transactions accurately, and to verify identities. We trust governments and central banks to manage our currency's value and stability. But what happens when that trust falters? What if the very institutions designed to protect our money become the source of its problems? This question lingered heavily in the air during one of the most tumultuous financial periods in modern history, setting the stage for a radical idea, a departure from tradition, that would challenge the very concept of money itself. In the shadow of the 2008 global financial crisis, as banks crumbled and economies teetered on the brink, public trust in centralized financial institutions hit an all-time low. It was a moment of profound disillusionment. During this period of widespread uncertainty, a mysterious figure, or group, operating under the pseudonym Satoshi Nakamoto, published a white paper titled Bitcoin, a peer-to-peer electronic cash system. This document didn't just propose a new currency, it outlined an entirely new way to build a financial system from the ground up, one that removed the need for any trusted third party, shifting the power dynamic fundamentally. On January 3, 2009, the very first block of Bitcoin, known as the Genesis block, was mined. Embedded within its code was a hidden message, a headline from the Times newspaper: Chancellor on brink of second bailout for banks. This wasn't just a timestamp, it was a clear political statement, highlighting the very crisis Bitcoin was designed to circumvent. From that moment, Bitcoin, a completely decentralized digital currency, began its journey. It emerged not as a company, or a product from a corporate giant, but as an open-source protocol, a piece of software available to anyone, everywhere. The most fundamental truth about Bitcoin is that it is purely digital. Unlike the coins and banknotes in your wallet, Bitcoin has no physical form. You can't hold it, touch it, or store it under your mattress. It exists solely as entries in a distributed ledger, a record of transactions across a vast network of computers. This digital nature is often a point of confusion for newcomers, who instinctively look for a tangible representation of value. But just like the digital dollars in your online bank account, Bitcoin's value isn't derived from its physicality, but from its scarcity, utility, and the network that secures it. Perhaps the most radical departure from traditional finance is that Bitcoin has no central bank or single administrator. There's no CEO, no board of directors, no government printing press controlling its supply or dictating its rules. Instead, Bitcoin is governed by its code and maintained by a global network of participants. This decentralized structure is the cornerstone of its resilience and independence. It means no single entity can shut it down, censor transactions, or arbitrarily inflate its supply, offering a powerful alternative to systems historically prone to human error and manipulation. Think about sending an email. You don't need a central email authority to approve every message, do you? It goes directly from your computer to the recipients. Bitcoin works on a similar principle. It's designed for peer-to-peer transactions without intermediaries. When you send Bitcoin, it moves directly from your digital wallet to the recipients, bypassing banks, payment processors, and other traditional financial gatekeepers. This direct connection dramatically reduces costs, speeds up transfers, and offers greater privacy for users, shifting control from institutions back to individuals, fostering a truly direct financial relationship. So, if there's no central bank, how does everyone agree on who owns what? This is where blockchain technology comes in. Bitcoin operates on a technology called blockchain, which is essentially a public distributed ledger. Imagine a gigantic, continually updated spreadsheet that's copied and maintained by thousands of computers all over the world. Every Bitcoin transaction, every change of ownership, is recorded as a block of data. Once a block is added, it's cryptographically linked to the previous one, forming a chain of blocks, creating an immutable and transparent history of all transactions, visible to anyone. When you send Bitcoin, that transaction isn't instantly approved by a bank. Instead, it's broadcast to the entire Bitcoin network. Thousands of computers, called nodes, then verify the transaction using cryptography. They check that you actually own the Bitcoin you're trying to send, that you haven't tried to spend it twice, and that the transaction adheres to all of Bitcoin's rules. Once enough nodes agree that the transaction is valid, it's bundled into a new block of data and added to the blockchain. This collective verification ensures the integrity of the system without needing a central authority. The process of adding new blocks to the blockchain is called mining. Bitcoin miners are powerful computers that compete to solve complex computational puzzles. The first miner to solve the puzzle gets the right to add the next block of verified transactions to the blockchain and is rewarded with newly created Bitcoins, along with transaction fees. This mining process not only introduces new Bitcoins into circulation but, crucially, secures the network. It makes it incredibly difficult and expensive for any single entity to tamper with the transaction history, ensuring the network's integrity and resistance to attack. One of Bitcoin's most defining and powerful characteristics is its fixed and limited supply. Unlike traditional currencies, which central banks can print at will, there will only ever be 21 million Bitcoins in existence. This hard cap on supply is programmed into Bitcoin's code and cannot be changed. This engineered scarcity is a primary reason why Bitcoin is often described as digital gold. Like gold, its value is derived, in part, from its finite nature, offering a stark contrast to inflationary fiat currencies and presenting itself as a potential hedge against currency debasement and a reliable store of value over time. While there will only ever be 21 million whole Bitcoins, this doesn't mean you have to buy or send an entire Bitcoin. Bitcoin is incredibly divisible. Just as a dollar can be broken down into 100 cents, one Bitcoin can be divided into 100 million smaller units called Satoshis, named after its creator. This means you can transact with very small fractions of a Bitcoin, making it practical for everyday purchases or smaller investments. This divisibility ensures that Bitcoin can serve as a medium of exchange for transactions of any size, from a cup of coffee to a multi-million-dollar asset transfer, without being restricted by its overall scarcity. Bitcoin's value isn't just determined by its scarcity, it's also heavily influenced by network effects. Think of a phone. A single phone isn't very useful, but millions of phones connected create immense value. Similarly, the more people who use, accept, and build on Bitcoin, the more valuable and useful the network becomes. Its value is determined by supply and demand, but that demand is directly tied to its growing adoption and utility as a medium of exchange, a store of value, and a foundational layer for new financial applications. It's a self-reinforcing cycle that drives its long-term potential. Another crucial truth about Bitcoin transactions is their irreversibility. Once a Bitcoin transaction is confirmed and added to the blockchain, it cannot be undone. There's no chargeback button, no central authority to call and dispute a payment. This feature offers immense security against fraud for merchants, as they can be certain once a payment is received, it's final. However, it also places a greater responsibility on the user to ensure they are sending funds to the correct address, as a mistake can be costly. This irreversibility is a core tenet of Bitcoin's trustless design, where cryptographic proof replaces the need for mediators. Many mistakenly believe Bitcoin offers complete anonymity. The truth is, Bitcoin transactions are pseudonymous, not anonymous. While your real-world identity isn't directly attached to your Bitcoin address, every transaction is recorded on the public blockchain. Anyone can view the sender's and receiver's addresses, the amount transferred, and the timestamp. With enough effort in data analysis, it's often possible to link Bitcoin addresses to real-world identities, especially when funds move through regulated exchanges. So, while it offers a degree of privacy, it's far from the completely untraceable cash some imagine, embodying a transparency often overlooked. How can a system without a central authority be secure? Bitcoin's security relies entirely on sophisticated cryptographic proof, not trust in third parties. Each transaction is digitally signed by the sender using a private key, which is mathematically linked to their public Bitcoin address. This cryptographic signature ensures that only the rightful owner can spend their Bitcoins and that transactions cannot be altered once broadcast. The entire network constantly verifies these cryptographic proofs, making it computationally infeasible to forge transactions or double-spend Bitcoins, providing a level of security that rivals, and in some ways surpasses, traditional financial systems. Bitcoin is an open network, meaning anyone with an internet connection can participate. There are no geographical boundaries, no national holidays, and no banking hours. Whether you're in New York, Nairobi, or New Delhi, you can send and receive Bitcoin 24/7, 365 days a year. This global, borderless nature makes it an incredibly powerful tool for international remittances, cross-border commerce, and financial inclusion for the unbanked populations of the world. It provides a universal payment rail that transcends national currencies and traditional financial barriers, fostering a truly global economy. While Bitcoin is primarily known as a digital currency, its underlying technology, the blockchain, has implications far beyond just money. The innovation of a decentralized, immutable ledger system has opened the door for a vast array of other decentralized applications, or dApps. These can range from new forms of digital identity and supply chain management to entirely new financial instruments and online voting systems. Bitcoin pioneered the concept of truly decentralized digital property, and its success paved the way for a new wave of innovation built on similar principles, hinting at a future Internet of value. In its early years, Bitcoin was famously volatile, experiencing dramatic price swings that deterred many. News headlines often focus solely on these fluctuations, creating a narrative of extreme risk. However, it's crucial to understand that such volatility is common for nascent assets and small, emerging markets. As Bitcoin's adoption grew and its market matured, its volatility, while still present, has generally decreased. Moreover, its store of value proposition gained traction, leading many to view it less as a speculative gamble and more as a long-term asset, much like gold or real estate, capable of preserving wealth over decades, rather than days. One of the most common criticisms leveled against Bitcoin is its energy consumption, primarily due to the mining process. It's true that Bitcoin mining uses a significant amount of electricity. However, the full picture is often overlooked. Much of this energy comes from renewable sources, as miners seek out the cheapest power, which often happens to be surplus hydro, solar, or wind energy. Furthermore, comparing Bitcoin's energy usage to the entire traditional financial system, with its countless data centers, branches, ATMs, and international infrastructure, often paints a more nuanced comparison. It's a complex issue, demanding context and ongoing innovation in efficiency. If we strip away the speculation and the headlines, Bitcoin emerges as something far more profound than just a digital coin. It's a public utility for value, much like the Internet is a public utility for information. Just as the Internet revolutionized how we share data, Bitcoin is revolutionizing how we transfer and store value. It's an open, neutral protocol that allows anyone, anywhere, to participate in a global financial system without permission. This foundational layer provides reliable digital property rights, a stark contrast to existing systems where assets can be seized or debased at will by central powers. For millions living under authoritarian regimes or in countries plagued by hyperinflation, Bitcoin offers a lifeline of economic freedom. Consider the story of Maria in Venezuela, whose life savings were wiped out by inflation. Bitcoin became her escape hatch, a way to store value independently of her government's failing currency, allowing her to preserve what little she had left. Similarly, for migrant workers sending remittances home, Bitcoin offers dramatically lower fees and faster transfers than traditional services, ensuring more of their hard-earned money reaches their families. It's a tool for sovereignty, providing an alternative when traditional systems fail. Globally, billions of people remain unbanked, shut out of the traditional financial system due to lack of identity documents, low income, or geographical remoteness. Bitcoin changes this paradigm. With just a smartphone and an internet connection, anyone can access Bitcoin, creating a digital wallet and participating in the global economy. This inclusion empowers individuals who have historically been excluded, giving them access to savings, payments, and wealth creation tools previously unavailable. It offers a path to financial self-sovereignty, bypassing the need for gatekeepers who often impose insurmountable barriers for the poorest populations. In the digital age, the concept of property rights becomes complex. Who truly owns your online data, your digital assets, or even the money in your digital bank account? With traditional systems, ownership often comes with significant strings attached, subject to the whims of third parties or government policies. Bitcoin fundamentally alters this. When you hold your own private keys, you have undeniable, immutable ownership of your digital assets. No one can seize your Bitcoins, freeze your account, or prevent you from sending them. It's digital property rights enforced by mathematics, not by human institutions, a true paradigm shift. One of Bitcoin's most powerful, yet often misunderstood, truths is its censorship resistance. Because there's no central authority to approve or deny transactions, no one can stop a valid Bitcoin transaction from being processed and recorded on the blockchain. This means governments cannot freeze accounts, corporations cannot block payments to competitors, and individuals cannot be deplatformed from the financial system. For activists, dissidents, or anyone operating under oppressive regimes, this feature offers a critical tool for maintaining financial autonomy and supporting causes that might otherwise be stifled by traditional financial controls. The true genius of Bitcoin lies in its ability to facilitate trustless transactions. This doesn't mean you don't trust the person you're sending money to, it means you don't have to trust any intermediary. You trust the cryptography, the math, and the open source code that governs the network. This radical shift from trusting institutions to trusting code fundamentally changes how we can interact financially. It's a system designed to operate honestly and predictably, enforced by immutable rules rather than the fallible judgment of centralized entities, promising a future of unprecedented financial transparency and reliability. Many mistakenly try to understand Bitcoin through the lens of traditional companies or products. Is it a startup? Does it have a CEO? The answer to both is a resounding no. Bitcoin is an asset class, like gold or oil, but it's also a decentralized, open-source network protocol, like TCP/IP for the Internet. It's not owned by anyone, it's maintained by everyone who participates. This distinction is crucial. It's not a business you invest in, it's a network you can participate in, a currency you can use, and an asset you can hold, existing as a public good for the digital age, free from corporate control. Let's revisit our earlier scenario of sending money across borders. For millions of migrant workers, remittances are a lifeline. Traditional methods, like wire transfers or money service operators, often charge exorbitant fees, eating into the hard-earned money meant for families back home. Bitcoin offers a dramatically cheaper and faster alternative. Imagine a worker in Europe sending money to their family in the Philippines, with minimal fees and near-instant settlement. This isn't a hypothetical, it's a reality for those embracing Bitcoin, providing a powerful demonstration of its utility as a global, low-cost payment rail that truly benefits the unbanked and underserved. In an era where central banks globally have engaged in unprecedented money printing, inflation has become a pervasive concern. Traditional currencies lose purchasing power over time, eroding savings. Bitcoin, with its fixed supply of 21 million, stands as a stark contrast. Its scarcity makes it resistant to inflationary pressures caused by arbitrary printing. For many, it represents a hedge against inflation, a way to preserve wealth in the face of currency debasement. It offers a unique form of digital scarcity that cannot be replicated, presenting a compelling argument for its role as a long-term store of value, especially in uncertain economic times. Since its inception in 2009, the Bitcoin network has operated continuously, without a single minute of downtime. It has survived numerous challenges, including massive price crashes, regulatory uncertainties, and attempts to hack or disrupt the network. Its resilience lies in its decentralized nature and the collective power of its global network of nodes and miners. The more distributed and decentralized a network becomes, the harder it is to attack or compromise. This track record of uninterrupted operation speaks volumes about its robust design and its ability to withstand external pressures, ensuring its ongoing availability and reliability. Despite the tales of early adopters becoming millionaires, Bitcoin is fundamentally not a get-rich-quick scheme. While its price has seen significant appreciation over its lifespan, it remains a volatile asset, and its value can go down as well as up. Viewing Bitcoin solely as a speculative investment misses its true purpose as a decentralized digital currency and a technological innovation. Its long-term potential lies in its ability to fundamentally change how we think about and use money, offering a more equitable, transparent, and resilient financial system, rather than just providing immediate financial returns to a select few. The regulatory landscape for Bitcoin has been, and continues to be, complex and evolving. Initially met with skepticism and outright bans in some regions, Bitcoin has gradually gained acceptance and recognition from governments and financial institutions worldwide. Countries like El Salvador have even adopted it as legal tender. Regulatory frameworks are being developed to integrate Bitcoin into existing financial systems, addressing concerns around consumer protection, anti-money laundering, and taxation. This growing regulatory clarity is a sign of Bitcoin's maturation and its inevitable integration into the global financial fabric, moving from the fringes to mainstream legitimacy. The aha moment for many comes when they realize Bitcoin isn't just another digital payment method. It's a foundational internet protocol for money itself. Like HTTP for websites or SMTP for email, Bitcoin is a protocol for value transfer, a neutral layer upon which a new, more open, and inclusive financial system can be built. It's an invention that gives humanity the unprecedented ability to send and receive digital value without relying on trusted intermediaries, freeing individuals from the constraints and manipulations of traditional systems. It represents a shift from centrally controlled finance to decentralized, verifiable truth. In the world of Bitcoin, your private key is your bank. It's a secret, alphanumeric code that grants you control over your Bitcoins. If you lose your private key, you lose access to your funds, irrevocably. If someone else gains access to it, they gain control of your funds. This places the ultimate responsibility and power directly in your hands. There's no customer service line to call, no bank to reverse a transaction. This can be daunting, but it also means you are truly sovereign over your money, free from the risks of custodianship by third parties, a level of financial independence unmatched by traditional systems. The truth about Bitcoin is that it's far more than a speculative asset or a niche technology. It's a quiet revolution unfolding beneath the surface of our global economy. It's a return to first principles of money, built on scarcity, verifiable proof, and open access. It champions individual sovereignty and economic freedom in an increasingly digital world. The real story of Bitcoin isn't in its daily price fluctuations, but in its potential to create a more transparent, efficient, and inclusive global financial system that empowers everyone, not just those with access to traditional banking infrastructure. Think of the entrepreneur in a developing nation who can now receive international payments instantly, without hefty fees or delays. Or the journalist in a censored country who can securely receive donations from abroad. These aren't just minor improvements, they're fundamental shifts that unlock human potential and foster innovation. Bitcoin provides a universal layer of value transfer that can be integrated into existing systems or used to build entirely new ones, enabling financial services to reach corners of the world previously deemed inaccessible or unprofitable by traditional finance. It's a powerful engine for global economic participation. In a world increasingly polarized and fragmented, Bitcoin stands as a beacon of neutrality. It treats all transactions equally, regardless of who is sending or receiving, or for what purpose, as long as they adhere to the network's open rules. This impartiality is a stark contrast to traditional systems that can be influenced by political agendas, corporate interests, or social biases. Bitcoin offers a neutral playing field for economic activity, a digital commons where value can be exchanged freely and fairly, without prejudice or gatekeeping. This neutrality is one of its most understated yet profound strengths. Bitcoin's journey is far from over. Rather than an outright replacement for all traditional finance, it is increasingly seen as a parallel system, a foundational layer that can integrate with and enhance existing financial structures. Imagine banks using Bitcoin's blockchain for instant, low-cost interbank transfers, or governments leveraging its transparency for public record-keeping. As the world becomes more digitally interconnected, the principles of decentralization, transparency, and trustlessness pioneered by Bitcoin will become ever more essential. Its evolution is ongoing, but its core truths remain steadfast, guiding us towards a new financial paradigm. The anonymous creator, Satoshi Nakamoto, gifted the world not just a digital currency, but a profound blueprint for decentralized trust. Their legacy is a testament to the power of open-source innovation and the belief that humanity can build systems that serve everyone, rather than just a powerful few. Bitcoin stands as a testament to cryptographic ingenuity, economic foresight, and a vision for a more equitable and resilient global financial future. It continues to inspire new generations of builders and thinkers to push the boundaries of what's possible in the digital realm, promising an endless stream of innovation. So, what is Bitcoin, truly? It is a decentralized digital currency, operating on a public distributed ledger called blockchain, without a central bank or single administrator. Its transactions are verified cryptographically, it has a limited supply of 21 million, and it enables peer-to-peer transfers without intermediaries. It is a scarce digital asset, offering economic freedom and censorship resistance. Bitcoin is a public utility for value, a new foundation for digital property rights, and a system built on trust in code, not institutions. This is the truth about Bitcoin that nobody tells you, because it challenges everything we thought we knew about money. As we conclude, the choice is now yours. Will you dismiss Bitcoin as mere internet money or a speculative gamble? Or will you recognize its profound implications as a foundational technology reshaping finance, offering a path to greater economic freedom and individual sovereignty? Understanding Bitcoin is not just about understanding a new currency, it's about understanding a fundamental shift in how trust, value, and power can operate in our increasingly digital world. The journey into the truth of Bitcoin is a journey into the future of money itself.